Hey everyone, Travis the Stock Geek here. Today's video is a little painful for me because I'm going to be talking about the biggest investment mistake that I've made in my investing career so far. And that mistake actually wasn't a loss, but it was a mistake that caused me to leave over $100 million of profit for our hedge funds investors on the table. Since hedge funds typically charge 20% performance fees on investment profits, then doing the simple math tells us that my firm lost out on at least $20 million of income. As you can imagine, that likely means I missed out on at least $1 million of bonuses personally. So why am I talking about this painful mistake? Well, even great investors don't get every single investment decision correct. So it's important that a serious investor study their past mistakes so they can get better over time and avoid making the same mistake in the future. It's not any different than how a professional athlete might approach their game. And my hope is that by opening up to you all, that you might avoid this mistake that I made. So what was it and what happened? At the hedge fund in early 2008, I had been researching the online travel sector, including companies like Orbitz, Expedia, TripAdvisor, and Priceline. We had already made an investment in that sector, and I had also identified Priceline as a well-run company with a great CEO and an intriguing growth opportunity in their hotel booking business in Europe. You see, although Priceline.com was known as a place to book mostly US-based airline tickets and hotels, they bought several companies around 2005 that became Booking.com. You probably know that name since Booking.com is now one of the largest travel booking sites globally. Those acquisitions cost Priceline less than $200 million at the time, and Booking.com became a huge growth engine for Priceline, propelling the company to revenue growth in excess of more than 40% a year. Eventually, that acquisition would be crowned as one of the top 5 best acquisitions in history. But back to early 2008, Priceline stock was already up about 300% in 2 years given the company's strong growth. I thought the stock was a little expensive and I wanted to wait to see if it would correct to a level where I wanted to buy. Sure enough, the great financial crisis began to unfold in the fall of 2008 and the stock market went into freefall. In September and October 2008, Priceline stock fell nearly 50%. The company's growth rate began to decelerate significantly as unemployment rose quickly and global travel spending took a hit. I had to try to figure out what various scenarios might look like for Priceline in a deep recession. I continued my research, I went to conferences, talked to industry people, dug through financial filings, talked with Priceline's management team, and then I modeled out different financial scenarios and estimated probabilities for each scenario. In early November 2008, Priceline had traded down to around $50 per share, or around a $2.2 billion market cap. Now, Priceline had been generating around $250 million of free cash flow in the prior 12 months, which means the company was being valued at less than 10 times trailing free cash flow. That's a very low valuation multiple for a company that had just been experiencing high growth and potentially had a long tailwind of future growth once the economy stabilized. That price was well below what I modeled to value the company to be in most scenarios. So our fund bought close to 100,000 shares right around $50 per share, for a total cost basis of $5 million. And guess what? We basically bottom ticked the stock. Within 6 months, the stock recovered and traded above $100 a share again. We doubled our investors' money in that position in 6 months, a fantastic result. And because this was still just the middle of 2009, there was so much uncertainty about the Great Recession and if things could still get worse. So we sold the entire position for a nice $5 million gain. And that was the big mistake. You see, Priceline's stock went on to grow massively over the next decade, becoming one of the best performers in the overall market. The stock broke $1,000 per share in late 2013 and then broke $2,000 per share in mid-2017. We sold it for a double, but had we held it, we might have had a 40-bagger or 4,000% return in just 9 years. Our 100,000 shares would have been worth about $200 million. So even if we had sold some of our shares at, say, $500 a share, some at $1,000 a share, and some at $1,500 a share on the way up, we still could have booked in excess of $100 million in profits for our investors, rather than just the $5 million that we ended up booking. So here's the lesson. When you find an exceptional company at a great price, do not sell the entire position for a quick gain, because exceptional companies will often grow faster and longer than you imagined. Check out this graph of Priceline's year-over-year growth rates, and you can see that Priceline was able to re-accelerate annual revenue growth above 30% for multiple years. And not only that, but the market will often take exceptional companies to levels that are way above fair value. This is why the famous advice, "let your winners run," is so widely given by experienced traders and investors. Exceptional finds like Priceline in 2008 are rare, and they can be the gift that keeps on giving to your portfolio. I still look at the chart of Priceline, which is now called Booking Holdings, frequently to remind myself of this lesson, because even after this painful mistake, I still have problems with selling my winners too early. I did this with Lululemon, Square, and Roku in the past 3 years. All fantastic stock picks, but my position management was not ideal. So one strategy that I'm using going forward to help me with this is to allow myself to take some profits when a stock hits my near-term price target, but cap the amount of position that I can sell in any given quarter. The only caveat there is that this rule does not apply if there's some material negative change to my investment thesis. Otherwise, I stick to the plan no matter what the market as a whole may be doing. Additionally, I'm making it a point to reevaluate my scenarios and probabilities, not just when things are trending negatively, but also when things are trending positively. Many investors get anchored to prior valuations and price targets too easily. That's called anchoring bias. To overcome it, you have to continually update and in some cases increase the levels at which you would buy and sell a great stock. There are cases where you should actually buy more of a stock you already own, even though it's gone higher, because the probability of the positive outcome has gone up. So that's my $100 million investment mistake. There are other mistakes that I talk about in my courses and in my videos as well. I break down some of the psychological and behavioral biases that underpin many of these common investing mistakes. So if you want to check out more of that, I'll link to my free hedge fund playbook in the show notes below this video. I hope my pain is your gain. Good luck out there, everyone, and I'll see you in the next video.